what we're seeing, it suggests that we are today where we were with the internet in 1995. And 1995 through 1999 was the biggest burst in the growth sector of the market in history. It went too far, too much capital chasing too few opportunities too soon, and so it ended badly. But we're just at the beginning of this, and we're pretty excited about it. And we think that this is much more on the consumer side.
Moments like this in financial history are rare. Every few decades, technology collides with macroeconomic forces to spark a new era of growth. Today, according to ARK Invest's Cathie, we are standing at a moment that mirrors 1995, just before the internet exploded into mainstream adoption and reshaped the global economy. Back then, markets experienced one of the largest growth surges in history, driven by innovation, optimism, and capital-chasing opportunity. It ended abruptly, but not before rewriting the rules of global commerce. Cathie argues that we're seeing the early stages of something very similar now, but this time, the scale of innovation and the economic backdrop could make the coming years even more transformative. Unlike the doom and gloom forecasts that dominate the headlines, Cathie believes inflation is receding, productivity is poised to rise, and a wave of technological progress is setting the stage for unprecedented economic expansion. One of her strongest points is that real GDP growth, helped by deregulation and innovation in fields like AI, robotics, nuclear energy, and blockchain, could exceed expectations and gradually reduce the deficit as a percentage of GDP. This is not an abstract claim. In the Reagan to Clinton transition of the 1980s and 1990s, strong growth turned deficits into surpluses. Cathie suggests a similar outcome is possible in the years ahead. At the same time, deregulation is unleashing dormant sectors of the economy. For decades, nuclear energy in the US was held back by regulatory barriers, while other nations like China built aggressively. Today, those barriers are finally breaking down. With artificial intelligence driving exponential demand for computing power and energy, the US is moving rapidly into what Cathie calls a new nuclear age. Small modular reactors, advanced energy storage, and broader deregulation in AI and crypto are setting the stage for productivity gains that could fundamentally change the US growth trajectory. In this video, we'll break down her latest analysis from her monthly In the Know podcast. From the deficit to deregulation, unemployment to innovation platforms, Cathie provides a roadmap that challenges the consensus view of stagnation and crisis. So stick around, because in a moment, you'll hear her full insights. And if you enjoy this kind of forward-looking analysis, make sure to like this video, subscribe to the channel, and drop your thoughts in the comments below. Thanks, and enjoy the video.
Just keeping our eye on this target, 3% deficit as a percent of GDP. You can see we've seen a small improvement. Tariffs are beginning to impact the deficit or improve the deficit. They're running somewhere between a $400 and $500 billion rate. That's an annual rate. And that would get the deficit over 1 year to roughly 4.8%. So continued progress we expect. This is a lightning rod issue for the markets, and it's because the interest level is so high already, higher, as many people know, than the defense budget, that it seems that that is going to be overwhelming. We won't be able to overcome this because just paying that interest bill is such a drain. And we are focused on it as well, but focused on ways to get it down to 3%. Tariffs will pick away at it, but we think much more important, besides the Doge cutbacks, which are still impacting government spending, with government layoffs featured prominently in the unemployment report. So those have a long way to go, actually. And then the other thing that we're focused on is real GDP growth. And we believe, as we've said many times before, that real GDP growth, starting later this year into 26, in time for the midterm elections, we think it's going to surprise on the high side of expectations, significantly on the high side of expectations. And so we think that is going to be probably the biggest answer to the deficit falling as a percent of GDP. This was also the answer in the Reagan years, moving into the Clinton years. There we ended with a surplus. And we do expect a surplus, maybe not in the next 3 years, but again, just like in the Reagan years, it takes time to turn the profligate spending around and correct for excesses. So within the next 4 to 5 years, we would not be surprised to see a surplus. Again, we're very dependent on real GDP growth. And as we've talked about many times in the past, we do believe that we're ready for prime time for all of the innovation platforms around which we have centered our research and investing for years. So robotics, energy storage, AI, multi-omic sequencing in the life science space, and blockchain technology. All of them are being catalyzed by AI. Of course, AI can't catalyze itself, but you know what I mean. All of the other platforms are being catalyzed, and I think the speed of change is going to be pretty shocking over the next few years. And there are shades of it, or signs of it, in the unemployment report, and we'll get to that in a minute. I just wanted to point to this chart as well, because I've just taken a trip through Asia, and it is clear that the only focus in Asia is on tariffs and those headlines, but they're not focused on the massive deregulation that's taking place in the United States. Crypto, we're seeing big changes there, of course, legislatively, and also in the court system and in the regulatory system. So there we're seeing the first executive order, I think, that President Trump rescinded, this was a Biden executive order, was on AI to free up innovation in that space. Nuclear energy, all kinds of energy to solve the power needs associated with AI and data centers. Huge deregulation, huge. Now that is slower moving by nature, but on our site you will see how much regulation has held back nuclear energy here in the United States and in Japan since the 70s. And we're rectifying this 50-year problem now at warp speed, at least for that sector. And just to give you a sense, China is constructing today 28 large-scale nuclear reactors. In the U.S., we are not constructing one. We have been so constrained by regulation. And the antidote to that has been small modular reactors, and those are proceeding apace. Again, regulation takes time, but again, proceeding apace. And we think from the largest to the micro nuclear reactors, we're moving into a nuclear age. When Brett Winton and I were at our last firm, Brett and his team authored a book, a big black book, on nuclear and how safe and sustainable it was and is. And then unfortunately, Fukushima happened in Japan. and unraveled nuclear for yet another decade, more than a decade. Again, the regulators had the upper hand around the world. And now we're back, and so that's good. All of these are going to feed economic growth importantly during the years ahead.
Cathie begins her analysis by zeroing in on the deficit, a lightning rod issue for markets. While many fear ballooning debt will choke growth, she points out that tariffs and fiscal adjustments are already improving the numbers, with the deficit moving closer to 4.7% of GDP. The real driver, however, is growth itself. Just as in the 1980s and 1990s, stronger than expected real GDP expansion could bring deficits down naturally. And according to Cathie, that expansion is coming, fueled by rapid innovation across multiple sectors. In her view, productivity breakthroughs, combined with deregulation, could be the most powerful tools in restoring fiscal health. This sets up her broader thesis. We are not facing a future of stagnation, but of acceleration. And yet, growth comes with friction points. In her next analysis, Cathie turns her focus to the labor market, unemployment, job creation, and the structural shifts AI is already creating.
Unemployment rate stayed at 4.3%. But employment itself, as measured by non-farm payroll, again, something for everyone in this report all the time, non-farm payroll, only an increase of 22,000. Now remember, the assumption in that 22,000 is that roughly 100,000 jobs were created by the net birth of new startups. And I don't know if that's happening. We'll see in the revision in the next, I think it's the next few weeks, we'll see that revision. That could take a lot of these numbers into negative territory. And in fact, one of the revisions took June into negative territory. And again, we have to adjust for what's going on with immigration right now. It could be that, could be cyclical, we don't know. Manufacturing was still negative. But the big news there is the work week dropped significantly. It dropped 0.5%. So not only are the number of jobs shrinking, but the work week is shrinking. That's not a good sign. And then surprisingly, tech is falling. Maybe not. We're hearing a lot of coding jobs are not there anymore. Financial services, maybe there are efficiencies now thanks to AI and blockchain technology. Business services, including temporary help, very negative. Government negative, down 16,000. On another negative note is the duration of unemployment, and I will get to that in a minute. I know we have it in here somewhere. I expect it to be there by now, but we'll get back there, and I will show you how the duration of unemployment is increasing, and it never got back to levels that we saw pre-COVID, and it's moving back up. So it's at 24.5 weeks on average is the average duration of unemployment. And if you look at the low in 22, we were at 19. In 20, before COVID, we were at roughly 10, before we shot up to 32 in COVID. So we are back up to 24.5. In past recessions, the duration of the unemployment rate has been roughly 20, so we're above that. Here's another inflation chart now into market indicators. Going nowhere as measured by commodity prices for the last 45 years. The peak was in 2007, and it was because of a lot of errant monetary and fiscal policy leaving the late 90s. So the Fed eased and eased and eased for all kinds of reasons. cause that massive inflation. If anything, I think this is going to break down before it breaks out. Here's the long-term Treasury yield over 45 years, and you can see it broke out. It's now levitating. We would not be surprised in the next, say, half year to see it go back to that 3% range, that base that you see in the 2010 to 2020 range is probably now going to be the low for this cycle. And we don't want these rates to go back to zero because that was a very unhealthy environment. We think the market's working much better now. And according to this metric, which is high yield spreads, the market is seeing very little risk out there. We think there are excesses in the bond market, and we're certainly seeing, I think this week, record highs in commercial office delinquencies. I think 11.7% was the number, higher than in 08-09 by roughly a percentage point. And yet, no problem according to this much broader based measure. We think the search for yield out there is where the excesses are, and there's too much risk being taken in the bond market by investors. And this last chart, Bitcoin to gold, so has not broken its uptrend, but has had a setback in here as Bitcoin has settled down and gold has continued to go up. Our bet is that Bitcoin will continue this uptrend over time, but we are paying attention, trying to understand what is gold telegraphing relative to Bitcoin. So with that, I think I've peppered in a lot of innovation. I'll end with this. Brett Winton, our chief futurist, featured a chart today during our brainstorm, which compared what's going on now with ChatGPT and other LLMs, chatbots in the consumer space relative to uptake in the internet days on PCs. And what we're seeing, it suggests that we are today where we were with the internet in 1995. And 1995 through 1999 was the biggest burst in the growth sector of the market in history. It went too far. Too much capital chasing too few opportunities too soon. And so it ended badly. But we're just at the beginning of this, and we're pretty excited about it. And we think that this is more on the consumer side.
The jobs report reveals a mixed picture. Unemployment steady at 4.3%, but job growth slowing sharply, with revisions even pushing some months into negative territory. Work weeks are shrinking, manufacturing remains weak, and high-value sectors like tech and finance are seeing disruption. For many, this would be a red flag. But Cathie interprets it differently. She sees evidence of structural change, automation and AI reshaping work, blockchain cutting inefficiencies, and government layoffs reducing spending. These are painful adjustments, but they point to higher long-term productivity. Her market outlook follows the same logic. Inflationary pressures have cooled, Treasury yields are stabilizing, and spreads in the high-yield market suggest limited near-term risk. At the same time, excesses in bonds and commercial real estate hint at vulnerabilities. Yet Cathie circles back to innovation as the ultimate driver. The comparison she makes between today's blockchain and AI adoption and the internet's explosive rise in the late 1990s captures both the opportunity and the risk. Back then, capital moved too fast. Today, the foundation is stronger, the technology's broader, and the potential impact far greater. For crypto investors, this analysis is particularly bullish. As Cathie notes, Bitcoin remains in a long-term uptrend against gold, signaling resilience even through volatility. If her projections for growth and innovation hold true, digital assets, especially Bitcoin, stand to benefit from both institutional adoption and their role as hedges in a rapidly transforming economy. In other words, just as the internet boom of the 1990s produced trillion-dollar companies, the AI and blockchain era could cement crypto's place as a cornerstone of global markets. If Cathie Wood is right, we are not at the end of a cycle, we are at the beginning of one. The next 5 years may surprise even the most optimistic forecasters, with innovation driving growth and new technologies reshaping wealth creation. What do you think? Are we really standing in a 1995 moment for the markets? Let us know in the comments, and don't forget to like, subscribe, and share this video with others who follow innovation and crypto. Thanks for watching.